Hello, and welcome to OnPoint, a podcast by Oak Street Funding, where we sit down with industry leaders to bring insights to the topics you want to hear about. I'm your host today, Matt Staninger, and let's get on point. Today, I'm joined by Steve Blake. Steve is Senior Managing Advisor at Evans May Advisory, and we are going to be talking about the latest tax bill that was recently signed into law by President Trump. We'll give you a brief summary of the bill, new and existing provisions, how it could impact the industries we serve, and more. Steve, thank you for being here today.
Thank you, Matt. I appreciate you guys having me.
To start off, can you give us a general overview of tax changes applicable to our lines of business?
Yeah, so this latest tax bill that was signed into law by the president on July 4th is fairly comprehensive. I don't know if anybody remembers when Trump was president the first time we passed the Tax Cuts and Jobs Act, the TCJA, and it was the biggest change in tax code since the tax code change of 1986. So it had been decades since we'd had such a major tax bill, and now we've got another one here to start Trump's second presidency. You know, the bill's of roughly 870 pages. The executive summary is about 56 pages. So there are a lot of provisions. And a lot of what it's doing is trying to extend or make permanent provisions from that Tax Cuts and Jobs Act of 2017. So a lot of those provisions were either in the process of expiring or were about to expire. So most of what this bill does is simply extend those provisions and allow us to have those tax benefits going forward.
Great summary. Let's talk a little bit about those extensions. What has stayed exactly the same or is very, very similar, but being extended in a modified way?
Yeah, so there are a number of provisions that are being either extended or made permanent. So to give you some examples, the Tax Cuts and Jobs Act reduced the individual tax rates. So the highest tax rate became 37%. Those tax rates were set to expire in 2026. Those are now made permanent in the law. So those tax rates will continue forward until the law is changed. Another example on the business side would be bonus depreciation. So for a number of years, we had 100% bonus depreciation. So in the year that you purchase a fixed asset, you can take a deduction for the full cost. Well, as part of the Tax Cuts and Jobs Act, that was sunsetting over a period of years, and that percentage was stepping down 20% every year until it was gone. And we had already gotten down to, I think this year we were at, I want to say the 40% mark for 2025. Well, what this bill does is take it back up to 100% and make that permanent going forward. So there are a number of provisions that are just being made permanent that were in the law in the past. And in some instances, we've had for even decades. But they always expired every couple of years, and Congress would have to negotiate and try and come up with some method of getting those extended or adding a few more years to it. So it's nice that a lot of these provisions are now being made permanent in the law.
What are some of those areas that are completely new with this bill?
So one of the biggest changes that came out of this bill, because a lot of what it does, like I said, is either just extends or makes permanent old provisions, or it fixes things that had expired in the last couple of years. So like to give you an example of that, in the past, research and development, you were able to deduct the expenses related to research and development while also taking a tax credit related to those expenses. A few years ago, the law changed wherein you could still take the credit, but you could not deduct the expenses in the year they were incurred. You had to capitalize them and amortize them, basically deduct them over a number of years instead of deduct them in the year they were incurred. And so one of the things this bill does is fix that issue and allow you to go back to fully deducting those expenses in the year they're incurred. On the individual side, we have what they're now calling these Trump accounts. It's basically almost like an IRA, a retirement account for minors. And what it allows you to do is put money into these accounts for anybody that's under 18. And then at age 18, they can actually start taking the money out. Part of the idea here is to help them kind of get a start in life.
Great. So there are some new features and some that we were used to at one point in time that went away, have now resurfaced. This, of course, was a bill that was being worked on essentially since Trump first took office in January. Mm-hmm. And there was a lot of backtracking between the House, between the Senate. or between the executive branch there. What were some of those areas that really had a lot of friction there that extended the timetable before approval was ultimately reached?
Yeah, that's a great question. So, a lot of these provisions they've been talking about even since before Trump was elected, even before election day. So, last year, there were bills moving through Congress trying to fix some of these issues we've talked about, things that were expired or already expired from the Tax Cuts and Jobs Act. There was this big looming deadline, so to speak, that at the end of 2025, a lot of those provisions were either going to be gone or were in the process of phasing out, and people were going to see a lot bigger tax hit. And it became this big problem that Congress has been looking at for a while. The problem that they ran into is getting everybody to agree on how to fix all of those provisions, especially within the rules within the Senate and the rules that they have to follow in order to pass a tax bill like this. And so what they've been negotiating about over the last year or more are some of the specific provisions. So to give you an example of that, under the Tax Cuts and Jobs Act, for individuals itemizing their deductions, they were allowed to take a $10,000 state and local tax deduction. So your income taxes, your property taxes, things like that you pay the state and local governments, and that deduction was limited to $10,000. Well, that was a huge issue for a number of states that have higher tax rates. So California, Illinois, New York, that created a lot of problems for those constituents. So the congressmen and women and the senators from those states, that was a huge issue for them. They wanted to make sure that cap either got eliminated or got raised. Well, part of the problem is you've got to figure out, hey, if we're gonna decrease taxes somewhere, you got to have some way to pay for that. So somebody else has to pay a tax somewhere. So a lot of what they've been negotiating about over the last year is, hey, in my state, we're hit specifically by these provisions that are being addressed. And we want these changes to those provisions. And that's going to cause us to impact other states. Well, those states don't want those changes to have to pay for these states to have lower taxes. So now you've got to negotiate. How do you come up with a way of paying for those tax cuts for those states that are negatively impacted by some of these provisions? And so there's been a lot of negotiation. And with the new Congress, there's such a narrow margin of Republican control in the House and the Senate, and there are people that are Republicans from those states that have those issues. So they were really kind of holding out to how are we going to fix those particular provisions. And then you've got the Democrats coming along and talking about things like, they want to increase the child tax credit and all these various other provisions. And so it really kind of came down to there were so many things being changed. There was just a lot of negotiation that had to take place between all the different members of Congress, the House of Representatives, and of the Senate, and that the president was willing to agree to. So luckily, over the last couple of months, they've really pushed hard, come to some agreements. So, for example, the child tax credit did get an increase. That state and local tax cap did get increased. But some of the other provisions, such as some of the clean vehicle credits, those got eliminated. It's one of the ways they're paying for some of these provisions. So there are winners and losers in all of this, and it was just a matter of finding the right mix that you could get enough people to vote for it.
Very good points there. It sounds like a lot of the provisions then that had produced those sticky points were more so on the individual standpoint. Thinking of the provisions though, which ones should the small and mid-sized businesses really be aware of?
Yeah, so I've kind of already mentioned the research and development expenses, being able to deduct those right away while still being able to take the credit. That's huge for small to medium-sized businesses because you get kind of a double tax benefit for doing that research and development, coming up with these new products, these new processes, and really being innovative and helping the economy, helping technology. So those are huge for small to medium-sized businesses that are especially developing some new product. Um, and in addition to that, I would say, the extension of the 100% bonus depreciation, that's huge because it allows you to deduct those expenses right away, especially for a small startup business that are spending a lot on those fixed assets at the beginning of their business cycle. They can really take advantage of those tax benefits, save some money, and use that money to help build and grow that business. Kind of related to bonus depreciation is Section 179. So that is a provision that allows you to elect expenses related to fixed assets. And that essentially doubled the amount that you're able to elect in a given year. So in certain circumstances, you can't take bonus depreciation, but you can still make the 179 election and still get that deduction. And by increasing the amount that you can elect for that deduction, now you're allowing the small to medium sized businesses, if you can't take bonus, hey, you can at least maybe elect 179. Now, 179 will create a loss. It can't make you go below zero for taxable income, but at least it can get you to zero.
So, thinking from your role as a CPA, for the rest of the year or even going into next year, how should small or mid-sized businesses be impacting or changing their strategy?
So I think because there are so many changes here, I think I kind of mentioned earlier, this bill is 870 pages. The summary is 56 pages. There are probably hundreds of changes within this tax bill, all of which kind of impact each other. There are phase outs. So we could talk about the increase to the child tax credit, but who gets to take that? We can talk about tips or tax free, but who gets to take that? Because it depends on your level of income. So what I would tell you is all of these things kind of interplay together and really impact what your net tax number is. So what I would say is because there are so many changes, it's hard to look at any one change in isolation. What I would recommend doing is a multi-year projection. So starting with what you think book income is going to be this year, and then using very sophisticated analysis in order to look at what are the tax implications of all of these changes. And then, okay, what are some of these changes that you want to maybe implement? So there are changes to the rules about employers paying off student loans for their employees. There are changes related to various benefits for employees, child care paid for by their employer, those types of things. So in addition to just looking at, hey, if we just keep doing what we're doing, what's the tax impact going to be as a result of all of these changes interacting together? But also what came out of this bill that we might want to take advantage of. What are some of those benefits that we get a deduction or a tax credit for? Any energy credits that are still available? What are the deadlines for some of these changes? So is there something we can do? Some of these changes go into effect September 30th. Some of them go into effect January 1st. Is there anything we can do before these deadlines come into play? And really take a full comprehensive look at the total impact of all of these changes and see what can we do before September 30th, before December 31st. What do we want to do next year? Like I said, do that multi-year projection and see how is this going to impact us from a tax projection standpoint, a tax implication. But then how do we want to also implement anything that came out of this bill that we might be able to benefit from?
Great. With it being such a long bill and there being so many provisions that could really affect different businesses so differently, what advice would you give to current CPAs on their phase in for the adjustment period for their roles?
Yeah, that's a great question. So a lot of what we're doing in our industry is really trying to digest the bill at this point because there were changes being made to it up until recently, up until right before it was signed. So just making sure we as CPAs have a full understanding of all of the provisions within the bill and how those impact our clients for this year, next year, and the following years. Because we talked about some of these provisions being made permanent, but some of them were just extended. So some of these provisions are only good through 2028. Well, what happens in 2029 and how do we need to start planning for that today? So really just trying to make sure as a CPA, we've got our hands around the full implications of the bill, how it impacts our clients. How do we even put these things on tax returns? How does that work? And then how do we explain it to our clients? How do we present it to our clients in a way that will help them understand it? But then for some of these new issues, some of these new things that were within the bill, well, how do you even go about doing that? If we want to create a Trump account for one of our clients' kids, well, how do you do that? Where do you go? There are companies out there right now that don't have the answers to that. So some of this is just going to take time. Because, for example, a company that does IRAs that's going to eventually have these Trump accounts, well, those don't exist yet. So a little bit of this is going to take the next couple of months for all the industries that were impacted to try and get all their processes, paperwork, rules, regulations, all of that in place to help everybody be able to even implement all of this. So some of this is also from a CPA perspective, just being able to talk through from our clients and working with our local professional networks on, hey, you guys handled this particular issue that came out of this bill. Where are you at with implementing that? What do you think the timeline is going to be? How's that going to work once you implement it? Where are you at in those discussions? So just making sure we're working with our professional networks to know, so we can then convey to our clients, hey, this is what we're hearing in the marketplace. This is how this is going to work. And we can help you through that process once it's ready to be rolled out.
So it's a continuing adjustment right now, a continuing preparation, and
It is.
and expanding that knowledge and education base while you can as things continue to develop.
Yes. Yeah. Very much so. Yes.
Great. With this, it of course has congressional approval, it has presidential approval. Would you anticipate there to be any judicial review that could have upcoming changes as well?
That is a great question because we do see a lot of challenges in the court system to a lot of things the executive branch has been doing over the last several months. But typically, with something like this, where you actually have a bill passed, the only real challenge that can be made is whether or not a provision violates either the Constitution, or an existing law that would somehow prevent that from being able to be implemented. Typically speaking, with tax provisions, you're not going to run into a lot of constitutional issues. I can think of a couple off the top of my head in the last few years that got challenged based on constitutional grounds, and typically the court will defer to Congress on those types of issues unless there's just a real blatant violation of the Constitution. So I don't really see a lot of court challenges coming out of this on the face of the bill itself. What we could see is, as this is rolled out and we see how it impacts various industries, those industry groups might try to mount a challenge to certain provisions of the bill because they're being treated unfairly under the provisions of the bill. And I'll give you an example of that. With a bill several years ago, there was a provision that specifically impacted dealerships. So, and especially RV dealerships, when you're talking about towable trailers versus RVs or motorhomes. And there was a legal challenge to that provision that ended up actually failing in the courts. But that's where you tend to see those types of challenges, as if an industry is hit specifically hard by a provision. And a lot of times it's an unintended consequence. It's something Congress didn't realize or think about until everything kind of gets rolled out. And then these industries start jumping up and waving their hands and going, hey, do you realize what you just did to us? And then a lot of times Congress will come back, sometimes even with, I've seen even a one-page bill that just fixes something for a particular industry. So a lot of times when that happens, the easiest way is to just get Congress to pass another short bill that fixes a particular issue, if you can get them to agree to it, because typically speaking, those court challenges, they make great headlines, but typically speaking, they don't have any real impact.
Great. What business moves would be strategic to take during the second half of this year with the tax changes in mind?
So I think if we look at it from a business perspective, we've talked about a lot about the 100% bonus depreciation. We've talked about Section 179, the R&D credits, really trying to get the economy going, spending money. And so I think from a tax benefit perspective, a lot of these things have been made permanent. So from a timing perspective, maybe there's not such a huge difference between this year and next year. But if it would help your business, maybe you go ahead and incur some fixed asset costs, some R&D costs, get some of these things going now, knowing that you at least have that tax benefit now, because as we all know, Congress changes over again in another year and a half or so. So we could have another tax bill at some point that might change what we currently have available to us. So you never know what the future holds, but we know what the tax code is right now. So if there are things that you can benefit from now, it's probably wise to take advantage of those.
Right. So we talked a little bit about R&D, some of those fixed costs. How about the M&A market? How should this be affecting the M&A market?
Yeah, so a lot of the provisions in the bill, I don't know that there was a big impact in the M&A world. Obviously, the tax rate staying low helps. Some of the provisions that got extended help. On the buyer side, obviously the bonus depreciation, the 179 extensions, those really help because as you're buying those businesses and you're putting those fixed assets on the books, you get those deductions right away, which helps offset your cost to purchase the business in the first place. So there are some provisions on the buyer side that will definitely help. On the seller side, probably just the tax rates would be a big benefit. Those not going up will definitely help. There was no change really to the long-term capital gains rate. That was one of the things that was being negotiated, was increasing those capital gains rates. That did not change. So on the seller side, that definitely helps. So now might be a good time if you're looking to sell. It would be a good time from a tax perspective for both buyer and seller.
And we should expect a few more years of that current
Yes.
condition.
Yes.
One of the provisions that had changed with this new bill was the interest expense deduction. So what are some of those things that could affect individuals that may affect the insurance agency industries?
So yeah, as the tax bill relates to various interest deductions, there are a couple of different provisions that come into play. One relates to new vehicle interest. So up to, I think it's $10,000, and you meet certain income requirements, and there's a couple of rules in play here, but basically you get to take a deduction for the interest you pay on purchasing a new vehicle. That's something that's never been allowed in the law before. So when you ask about new provisions, that's definitely something that's new. The other one that I can think of off the top of my head that relates to interest is when it comes to mortgage interest. So one of the things the Tax Cuts and Jobs Act did back in 2017 is it reduced the amount of mortgage interest that you could take. But that provision, again, was one that was going to expire. Well, this new bill extends that. And so there's a continuing limitation on the amount of mortgage interest you're going to be able to take. So it's been the same for the last 7 years or so, and it's just going to continue. But it's the fact that it's not going to expire is really the change there.
One of the large provision changes was around the estate and gift tax area, which could impact our RIA clients. So can you give a summary about that estate and gift tax provision?
In terms of the estate tax, one of the things that was done with the Tax Cuts and Jobs Act is it really increased the lifetime exemption. So the lifetime exemption is what we use when it comes to gift taxes. So giving something away while you're alive. And then when you pass away, there's the estate tax. So whatever passes on to your heirs, your beneficiaries. And so that exemption from tax had greatly increased under the Tax Cuts and Jobs Act. And based on inflationary increases to the exemption, it was, I'll call it 13.6, 13.7 million. I forget the exact number. But what this bill did is, because that provision was also going to expire. So starting in 2026, we were going to go back down to the old exemption. And so people that have large estates were going to end up paying a lot more in estate tax. And one of the things this bill did was it increased the exemption to 15 million and made it permanent in the law. And then that 15 million over time increases based on an inflation index. So definitely from an estate planning perspective, this is a huge win when it comes to people that have large estates. They'll be able to do more gifting while they're alive, pass on bigger estates with no tax implications after they pass away. And then now is probably a good time, if they hadn't done it under the Tax Cuts and Jobs Act, to try and put some kind of planning in place for their estate to make sure they're fully utilizing that increased exemption. Because while that's made permanent in the law now, as we all know, new Congress, new president, things could change.
Thank you, Steve, for being here to discuss taxes with me today, and thank you to those watching. For more information and access to free resources, visit us at oakstreetfunding.com or call us directly at 866-625-3863 to start a conversation. Let us help you navigate the evolving lending environment and secure the capital you need to thrive. Thanks for joining us on OnPoint.